So you're thinking about buying a home this year, or maybe you're already on the journey and you want to make sure that you don't mess it up. And I totally get it. In this video, I'm sharing everything I wish I knew before I bought my first home. These are the lessons that could save you thousands of dollars, tons of stress, and maybe even your dream home. Whether you're 25 or 45, the Canadian housing market isn't what it was 5 years ago, and you deserve the best playbook possible. I'll break down the real cost of buying, the truth about mortgages, and a bunch of mistakes that you can avoid. One that I've seen too many buyers make. And hey, if you're a visual learner or you want to save this for later, feel free to hit the subscribe button and let's dive in. So let's start with what most people think that they understand, but they usually don't: the upfront cost. First off, your down payment. In Canada, the minimum down payment is now tiered. As of 2025, here's how it works. For a home up to $500,000, you'll need 5%. And from $500,000 to just $1 under $1 million, it's 5% of the first 500 and 10% of the rest. And if you're buying anything $1.5 million or more, it's 20% no insurance options. So if you're looking at a $700,000 home, you're putting down $45,000 as a minimum. That's $25,000 of the first 500 and $20,000 of the next $200,000. But that's just one part. The closing costs are the silent killers. They sneak up if you're not ready. Things like legal fees, land transfer tax, title insurance, and appraisals. These can add up to another 1.5 to 4% of the purchase price. If you're buying in Ontario or BC, remember, land transfer tax hits different. In Toronto, you'll get hit twice. And here's a pro tip: budget for 2 to 3% extra. Even if your realtor says you'll be fine, you'd rather have the extra money and not need it than the other way around. And lastly, you'll need something called a cash reserve. Lenders want to know that you've got 2 to 3 months of mortgage payments sitting in your account after closing. It's a safety buffer, and if you don't have it, some lenders won't approve you. The bottom line, upfront costs aren't just about scraping together for the down payment. There's a full stack of expenses, and knowing those upfronts means you're prepared and you're not panicking. Now, let's talk about the ongoing cost of home ownership. Now that you're in your home, let's talk about what it actually costs to own month to month. These are the ongoing costs that catch a lot of first-time home buyers off guard. First up, your mortgage payment. This includes principal and interest, and it's likely your biggest monthly bill. But here's the thing: depending on your down payment and the loan type, you might also need to pay insurance. If you put down less than 20%, you'll likely be paying into Canadian Mortgage and Housing Corporation, known as CMHC, for insurance, and it gets rolled into your mortgage. Next, you've got property taxes. These vary from city and are based on your home's assessed value. Budget anywhere between 0.5 to 1.5% per year. And don't forget about home insurance. It's required by your lender and protects your home against damages or even disasters. Want to live in a condo or a gated community? You're likely paying HOA fees or condo fees. These cover maintenance of common areas, but they can be hundreds of dollars per month. Speaking of maintenance, you now own the place. That means you're the landlord and the handyman. Budget 1% of the home's value per year for maintenance and repairs. That's $5,000 a year on a $500,000 home. And utilities, well, they're like water, gas, electricity, internet. They're all on you now. Make sure you factor these into your new budget. So let's recap. You've got a mortgage, insurance, taxes, fees, maintenance, and utilities. Owning a home can feel like managing a small business, but if you budget for it, it won't break you. So let's talk about a pre-approval versus what you can actually afford. Let's clear something up. Being pre-approved doesn't mean that you can actually afford the home. It just means that the lender thinks that you might be able to pay it back. Pre-qualification is just an estimate based on what you tell the lender. Pre-approval is a little bit more serious. They check your income, debt, and credit score. But here's the catch. Lenders approve you based on your gross income, not your lifestyle. They don't know how much you spend on travel, daycare, or even avocado toast. The general rule is don't let the mortgage exceed 28% of your gross monthly income. That's your max, not your goal. If your income is $6,000 a month before tax, your mortgage shouldn't be more than $1,680 a month. That gives you some breathing room for other expenses and savings. Now here's where it gets tricky. Real estate agents gets paid based on the price of the home you buy, so they may help you stretch a bit further. And when you overextend, that's when you end up house poor. You own a home, but you can't afford to furnish it or even go out. And that's dangerous because all it takes is one life event, a job loss, car repair, or unexpected medical bill, and suddenly the dream home becomes a nightmare. My advice is simply just don't do it. Stick to your budget, not your pre-approval. That's the smart way to buy a home in 2025. So let's talk about types of mortgages and picking the right one for you. All right, so you've got your budget locked down. Now let's talk mortgages, because not all loans are created equal. First up is fixed rate mortgages. This is the gold standard. Your rate stays the same, your payment stays the same, predictable and safe. Then there's variable rate mortgages. Your mortgage rate moves with the Bank of Canada. It can start lower, but it's a gamble. Rates go up and so do your payments. If you're someone who loses sleep over financial surprises, stick with fixed. But if you can ride the wave, variable might save you money. You just need to know the risks. Then we've got HELOCs, home equity lines of credit. Not your first step, but worth knowing. You borrow against the equity in your home. Now let's talk about amortization. How long it will take you to pay your mortgage. 25 years is standard, but some can go up to 30 years or even 35 years with some lenders. Longer terms, lower monthly payments, but the more interest paid over time. Shorter terms equals higher payments, but a faster payoff. Choose what fits your lifestyle. One last tip, ask your broker to compare all of these options side by side. That's literally our job. It can save you tens of thousands of dollars over the life of your mortgage. Shopping for lenders, and why does it matter? So here's something wild. Most first-time homebuyers don't realize that you can actually shop around for a mortgage, like you do for car insurance or even a cell phone plan. And you should. And here's why. Because even a 0.25% difference in your mortgage rate could mean paying or saving thousands over the time of your mortgage. When you work with a broker like me, I'll check with the banks, the credit unions, non-bank lenders. I'll do all of them to find what actually works for you. And it's not just about rate. Different lenders have different policies, penalties, and perks. Some make it super expensive to break your mortgage early, others a lot more flexible. Always ask, what's the prepayment penalty? Can I increase payments without a fee? What happens if I need to refinance? Don't just go with your usual bank because it feels easy. Go with what's smart. Let the math decide, not the loyalty. And hey, we've seen people offered wildly different rates just because they've asked around. So do it. Ask, shop, and leverage. Now here's a final pro tip. Don't apply with a bunch of your lenders yourself. Too many credit checks can ding your score. Your broker can help pull your credit once and shop around for you. Now don't get caught in emotional traps or buyer mindset mistakes. Let's be real. Buying your home is emotional. You're dreaming about paint colors before you've even seen the inspection report. But here's where people get hurt. They fall in love with a home, ignore the red flags, and make bad financial moves. I call it the buyer blur. It's when your heart takes the lead and your budget gets blurry. You have to treat this like a business deal. Use logic. Run the numbers. If it doesn't make sense on paper, it's not the one. And please don't get rushed. Just because your cousin bought in 10 days doesn't mean that you need to. Seller agents, they want it sold. You want the right home on your timelines. Another big one, don't use the listing agent as your agent. That's like letting your ex represent you in your divorce. It's not in your best interest. Always work with someone who represents you. They'll help you ask the right questions and spot the traps. Your future self will thank you for staying cool, calm, and calculated, especially when everyone around you is spinning out emotionally. So let's talk about inspections, neighborhoods, and avoiding regrets. Before you sign on the dotted line, we've got to do our due diligence. The home inspection is not optional. It's your insurance policy. We've seen buyers skip this only to find out that the foundation is cracked, the roof leaks, or worse, termites. Pay for a thorough inspection. Ask about plumbing, electrical, roofing, mold, and drainage. And if possible, go see the house on a rainy day, and trust me, you're going to thank me for that one. While you're at it, research the neighborhood. Check crime rates, local schools, traffic, and noise. Don't just visit on a sunny Saturday, visit at night too. Another pro tip, chat with the neighbors. Ask them about the area, the street, and even the seller. They'll tell you what Google won't. And finally, check for renovation costs before you buy. Ask yourself, can I afford the upgrades I want and the repairs I need? If a home needs $50,000 in work and you've budgeted $20,000, you're setting yourself up for regret and not success. If the process is about protecting your future self, ask the hard questions now so that you're not dealing with the hard lessons later. So all right, you've made it this far. You're officially smarter than 95% of first-time home buyers. You're informed, prepared, and ready. And if you're looking for help navigating your mortgage options, well, I got you. You can always reach out to me directly. My contact info is linked below in the description.